Hello, my name is Reina Penalova. I'm Director of Research and Portfolio Manager here at Hightower, Las Vegas. At Hightower, we manage 4 main investment strategies. Today, we're going to talk about the optimized portfolios. At the core of the optimized portfolios sits the diversified growth portfolio. And in diversified growth, we target having about 70% of the exposure in US stocks, about 20% in international stocks, and then we also seek to have some precious metals, commodities, and global infrastructure for their diversification benefits. However, the portfolio doesn't always look constant over time. It shifts. Sometimes we want to take a more risk-on approach and have more exposure to the aggressive corners of the markets. And sometimes when we want to be more defensive, we're likely to do things like raise cash and add to safe haven assets like precious metals, for example. But how do we make those decisions? Let's look into the process itself. We first start with the asset allocation decisions. And for that, we take a long-term approach. To understand why, let's look at this graphic by JP Morgan. Here we have the investment returns for a 15-year period for the major asset classes. In white, we also have a portfolio that is simply equally weighted between all the asset classes that is rebalanced annually. On the left-hand side, you could also see the aggregate annualized return for the whole period for each of the asset classes in the portfolios, as well as the volatility. What's interesting is that by having a portfolio that simply equally weights all the asset classes, you could achieve higher return and lower volatility than the median. Also, by just looking at how colorful the chart is, we can conclude that we can't expect for one investment type to consistently outperform or underperform all others over time. So that's exactly what we're trying to achieve here. We're trying to tilt the portfolio towards the corners of the market where we think that there's greater value potential. But how is that determined? Well, we use a process called the Black-Litterman optimization. What that does is it looks at the long-term expected returns for all major asset types as estimated by the major banks. It also looks at things like correlations and risk metrics. It then recommends an asset allocation. Once we're done with that, we then focus on the business cycle. Ideally, if we think that we're towards the beginning of the business cycle, we would have a more risk-on approach in the portfolios. And then if we think that we're towards the end of the business cycle, we would take a more defensive posture. To estimate that, we look at the dynamics between growth and inflation, both domestically and internationally, but also other metrics like trends, correlations, sentiment indicators, and so forth. Finally, we arrive at security selection process. And for that, we take a value approach. We focus on profitability, on companies that have strong balance sheets, but then we also study the business closely to make sure that there's catalyst for future growth. And last but not least, we are always cognizant of valuations. It's important to have a good price that you pay when you first invest in an investment. Once the diversified growth portfolio is complete, we then add different proportions of bonds to it. We do that in order to decrease or increase the expected risk and volatility for the portfolios. And that's necessary so that we can help clients achieve their long-term financial planning objectives. At the end, the optimized portfolios are long-term in focus. They're also adaptable, and we're always trying to make the process repeatable and consistent. And not lose focus of the fact that price is what you pay, but value is what you get, like Warren Buffett likes to say. Thank you very much. Have a great day, and please don't hesitate to ask us any questions.